Does a PACE loan affect title? How do you pay it back? And what happens when you sell or refinance? PACE financing is different from a traditional second mortgage because repayment is generally made through a property tax assessment, and the assessment can create a lien against the property. PACE loans, the home improvement loan that can affect your title. Here's what you need to know. Hey everyone, I'm Brian Jahanbin and welcome back to the channel. Today, I want to talk about something a lot of homeowners don't fully understand: PACE financing. You may have seen advertisements for PACE financing to pay for solar, roofing, HVAC, windows, insulation, or other energy-efficient home improvements. It can sound great because you may not have to come out of pocket with a large down payment. But here's the question. What happens to your property title? How do you pay the loan back? And what happens when you want to sell or refinance? Let's break it down so you know exactly how it works. First, what exactly is a PACE loan? PACE stands for Property Assessed Clean Energy. Unlike a traditional home equity loan, PACE financing is generally repaid through an assessment collected with your property taxes. That means your property tax bill can increase because you're paying back the PACE financing through the tax system. Now here's where things get really important. PACE financing is connected to the property. The assessment creates a lien or assessment against the property, and PACE obligations can have a priority similar to property tax liens under applicable state law. So this isn't something you should think of as simply a regular personal loan. And that can become very important if you decide to sell or refinance your home. Let's say you finance $40,000 of improvements through PACE. You may have a repayment term of 5, 10, or even 20 years depending on the program. Instead of sending a separate traditional loan payment every month, the PACE amount is generally collected through your property tax payments. If you have a mortgage with an escrow account, your mortgage servicer may incorporate the PACE assessment into the amount being collected for taxes and your overall mortgage payment. Now let's talk about selling. This is where homeowners need to pay attention. Do not assume the PACE balance automatically disappears when you sell the house. The PACE obligation is associated with the property, and depending on the transaction, the buyer may potentially assume the ongoing assessment. However, the buyer's mortgage lender may require the PACE balance to be paid off as a condition of financing. The CFPB specifically warns that PACE financing can create challenges when selling or refinancing because mortgage lenders may require the PACE obligation to be satisfied. So imagine you sell your house for $800,000. You still owe $30,000 on your PACE assessment. If the buyer's lender says this PACE balance needs to be paid off before we can close, that $30,000 may have to come out of the transaction, and that means less money going to you at closing. Now let's talk about refinancing. This is another big issue. If you want to refinance your first mortgage, don't assume your lender will simply ignore the PACE balance. PACE can affect the underwriting and title process, and some mortgage lenders may require the PACE obligation to be paid off before refinancing. So before you sign a PACE agreement, I would ask 3 questions. Number 1, what is my total repayment amount? Don't just ask, what's my payment? Ask how much you're going to pay over the entire term, including interest and fees. Number 2, what happens if I sell my house? Get the answer in writing. Find out whether the balance must be paid off, whether the buyer can assume it, and whether the buyer's lender will accept it. Number 3, what happens if I refinance? Ask the PACE provider and your mortgage professional before you sign anything, because the financing that works today may create a problem when you refinance tomorrow. And one more important point for every homeowner to remember: if you fail to pay the PACE assessment, you're not simply dealing with a normal unsecured bill. Because the obligation is connected to the property tax assessment, delinquency can create serious consequences, including the risk of a tax sale or loss of the property. So, is PACE financing bad? Not necessarily. It can be a useful financing tool for certain homeowners and qualifying improvements, but you need to understand that it is very different from a traditional home improvement loan or HELOC. Before signing, look beyond the sales pitch. Understand the total cost. Understand the property assessment. Understand the lien implications. And most importantly, understand what happens when you want to sell or refinance your home. I'm Brian Jahanbin. If you're considering PACE financing and want to understand how it could affect your mortgage or future refinance, talk to a qualified mortgage professional and review the specific PACE agreement and title requirements for your property. And if you found this video helpful, subscribe to the channel because I'm going to keep breaking down the mortgage and real estate topics that homeowners need to know before they make expensive decisions.